Hello and welcome to the Weekly Market Metrics. I'm your host Sandeep Rao and we are in week 28 of 2026. And I'll be honest, this week I learned a lesson, and that's never to celebrate too early. You see, last week I sat here in this very room and said for the first time in close to 3 months, I don't have to start with news about Iran war. Guess what? I clearly jinxed it. The airstrikes are back, the US has reimposed oil sanctions on Iran, and Trump has now declared the ceasefire over. Though, technically speaking, while the peace deal hasn't been formally scrapped, but it's not showing any signs of life either. So yes, in a way we are back to square one. And it's not just geopolitics doing a U-turn. After 9 days of surplus rains where the country received over 40% above normal rainfall in the first week of July, El Nino seems ready to take its revenge, and the IMD is now forecasting below normal rainfall for the rest of the month. From almost flood-like conditions in Mumbai to a possible dry spell all in 1 week. The tables have truly turned 180 degrees. The markets understandably didn't enjoy any of this. Nifty crashed over 2% on Wednesday, almost touching 23,800, before staging a recovery, and as of Friday, we are back to around 24,200 levels. So on a weekly basis, we are almost flat to negative, down about 0.25%. And yes, as a special, I did some analysis of the relative strength trend across Nifty large, mid and small caps over the past decade. More on it later. With that, let's look at what happened last week and what could happen in the coming week. Without further ado, let's start with rate of change across indexes. First, the headline indexes. After several weeks of steady gains, Nifty 50 took a breather, slipping 0.2% over the week. The broader market, however, continued to show strength. Mid-cap 150 led the way with 1.2% gains, while micro-cap 250 and small-cap 250 added 0.8% and 0.7% each. Next 50 also managed to end the week in the positive territory. The broader trend remains intact. Over the last 3 months, microcap 250 continues to lead with an 18.9% return, while small-cap 250 has gained 15%. Nifty 50, meanwhile, has slowed just to 0.7% over the same period, suggesting that the market leadership continues to lie well beyond the headline index. Moving on to the ROC chart from the weekly market metric sheet, and that's on your screen. Looking at the broader indexes, Nifty Mid-Select was the clear standout this week, gaining 1.9%. It's now up 7.6% for the year and has become the first major index in our coverage to reclaim its all-time high position. Nifty Bank also edged higher, adding 0.2%, and it continues to trade less than 6% below its record high, while Nifty 50 took a small breather after last week's breakout and remains at about 8% below its peak. Looking at the year-to-date performance, the broader market continues to leave Nifty 50 way behind. Microcap 250 has extended its lead to nearly 13%, followed by small-cap 250 at 8.7%. Mid-cap 150 and Next 50 have also moved firmly into the positive territory, up 3.6% and 3.9% each. Nifty 50 meanwhile remains down about 7.4% for the year despite the recovery over the last 3 months. The gap has narrowed, but the story for 2026 remains the same. The broader market continues to significantly outperform the headline index. Further down in the episode, we'll look at a study as to how this relative strength across large, mid and small cap plays out. For now, let's look at Nifty on various timeframes, starting with the weekly timeframe. On the weekly chart, Nifty paused after 3 consecutive weeks of gains, slipping 64 points or 0.3% to close at 24,207. Despite the minor pullback, the medium-term structure remains constructive. Nifty continues to trade above both the 10-week and the 20-week SMAs, although it once again failed to reclaim the 40-week SMA, which continues to act as overhead resistance around 24,780. On the weekly chart, one level that continues to stand out is the 23,800 support zone. Over the last 4 weeks, Nifty has tested the zone multiple times, including this week, but has failed to register a single weekly close below it. That reinforces 23,800 as a strong support level. As we highlighted last week, the weekly trading range continues to expand. After increasing from 477 points to 549 points last week, it widened further to 725 points this week. The larger ranges suggest volatility is picking up, even though the market is still consolidating rather than trending decisively. At first glance, this looked like another quiet week, but a closer look at the daily ranges tells a very different story. Wednesday stood out with an exceptional 495 point range, accounting for nearly 70% of week's total range. The remaining 4 sessions were relatively subdued, with Monday, Tuesday and Thursday all seeing ranges between 170 to 210 points. Friday was the lowest at 108 points. As a result, the 5-day average daily range jumped to 233 points, well above the 10-day average of 198 points, indicating that short-term volatility has picked up despite the market ending the week almost unchanged. Let's now look at Nifty on the daily time frame. On the daily chart, the market gave traders plenty to think about this week. Monday and Tuesday continued the upward momentum from the last week, with Nifty pushing towards the 24,600 resistance zone. But Wednesday changed everything. In a single session, the index sliced the 24,000 mark, testing the 23,800 levels. That weakness, however, proved to be short-lived. Thursday and Friday saw a strong recovery, with Nifty ending the week back about 24,200 levels. From a moving average perspective, Wednesday's sell-off briefly disrupted the technical structure, with Nifty closing below the 100-day EMA, the 50-day EMA and even the 21-day EMA, all in a single session. However, the recovery on Thursday and Friday pushed the index back above all 3 moving averages by the end of the week. The next major hurdle now is the 200-day SMA, currently at around 24,850. A decisive close above that level could be an important technical milestone and could pave the way towards the psychological 25,000 mark. Moving on to the hourly chart, Nifty spent most of the Monday and Tuesday trading comfortably above the 50 EMA. Wednesday's sharp sell-off completely changed the picture, pushing the index well below the 50 EMA and likely triggered short positions across many trend-following systems. But as we've seen several times over the past few months, those shorts don't really last long. The same happened this time as well. The recovery over Thursday and Friday pushed Nifty back above the 50 EMA, with the index ending the week once again on the long side of the short-term trend. Talking about the Nifty weekly expiry, which happened on Tuesday, 7th of July, the ATM straddle opened at around 99 points, and until 3 p.m. Nifty traded within a fairly manageable 112-point range. But the last 30 minutes completely changed the picture. A sharp 110-point move after 3 p.m. expanded the day's total range to 182 points. We've been seeing these sharp 3 p.m. moves quite frequently on expiry days, which makes me wonder if there's an edge in being long gamma after 3 p.m. Those hero to zero trades, that kind of stuff. Let me know in the comments if you've been able to identify and trade and consistently profit from this kind of a pattern. Moving on to what to expect in the coming week. Well, looking ahead to the next week, the first level to watch out for on index is 24,200 to 24,250 zone. As long as Nifty holds above it, the short-term structure remains positive. On the downside, the 23,800, 23,650 zone continues to be an important support area, having held up through multiple tests over the past weeks. On the upside, the next major hurdle remains around the 200-day SMA, which is at 24,850. A decisive close above that level would be an important technical milestone and could open the doors towards the psychological 25,000 mark. Overall, the bias remains cautiously bullish, and the market once again defended key support and recovered quickly from the sharp sell-off that happened last week. The question now is whether the bulls can carry this momentum into the next week and finally challenge the long-term resistance around the 200-day moving average. If you look at the straddle premium to gauge the expected range for the upcoming weekly expiry on Tuesday, 14th of July, The Nifty at the mini straddle closed at 192 points, up 173 points last week, implying an expected move of roughly 0.79% on either side. That gives us an expected range of approximately 24,399 on the upside and 24,15 on the downside. Implied volatility has ticked up slightly from last week, suggesting the options market is pricing in a wider move. Now, whether the actual move stays within this range or once again surprises us with a sharp post 3 p.m. swing will be worth watching. Moving on to India VIX, well, the index edged up slightly this week, rising from 11.8 to 12.3 after touching its lowest levels in several months. While volatility expectations have picked up a bit, VIX remains relatively low. Another thing worth bearing in mind, as we've seen recently, a low VIX doesn't really rule out sharp intraday swings, especially on expiry days. Now, moving on to the performance of sectoral indexes this week, well, the leadership shifted once again this week, although the gains were far more muted than last week. Nifty Realty retained top spot with a 5.4% gain, followed by IT and Metal. PSU Bank and Services rounded out the top 5. Compared to last week, the market rotated away from defensive sectors like pharma, FMCG and consumption, with cyclicals such as IT and Metal making a comeback. Realty, however, continued to dominate for the 4th week in a row. Now, if I look at the TJI sector baskets and the weekly leaderboard, it is an interesting mix of IT large cap and recycling, both up 4.2%, with jewelry close behind at 4.1%. Well, a word of caution on IT. The basket is still down nearly 27% over the year, so this looks more like a bounce than a turnaround. The one that really stands out for me in the list is microfinance. It's up 3.2% this week, but more interesting picture is the consistency. 23% over a month, 26% over 3 and 6 months, 31% over the year, and trading right at its 52-week high. There seems to be some genuine industry tailwinds at play as the sector comes out of its latest credit cycle. If you want to take a deep dive, there's a fascinating conversation on Zerodha's Subtext podcast where Kashish speaks with Tamal Bandyopadhyay of Business Standard, one of the sharpest observers of Indian banking, on the microfinance credit cycle. A must listen if you're curious about the microfinance space. The link is in the show notes. Now, for a moment, zooming out to the baskets sitting at their 52-week highs, and there are as many as 8 of them this week. Microfinance, which we just spoke about, along with jewelry, specialty chemicals, recycling, auto ancillary, and interestingly, all 3 pharma baskets, pharma small cap, and API and CRAMS are each at their highs, each up around 24 to 25% over 6 months, and that's not one stock or one story. That's the entire pharma complex moving together. And if you're looking for consistency across time frames, 2 sectors stand out. Refractories is up 15% over the month, 23 over 3, 31 over 6, and 28% over the year. Steady compounding quarter after quarter. Recycling as well shows a similar staircase-like structure. Now, incidentally, I was having this conversation with Nuresh Mirani, a veteran market analyst, about sectors, and he too highlighted that parts of banking and auto ancillary are worth keeping an eye on. And sure enough, if you are looking at the table, auto ancillary is sitting at its 52-week high, and private bank is less than 1% away from its own 52-week highs. So there you go. Those are the ideas on my radar for the week. As always, do your own research, and none of this is a recommendation. Moving on to commodities, and after last week's relief rally, both gold and silver came under pressure again this week. Gold M slipped back towards 1,44,000 levels, while Silver M fell below the 2,26,000 levels. From a technical perspective, not much has changed. Both continue to trade well below the 50 EMAs, keeping the broader trend firmly bearish. Until they reclaim those moving average levels, any bounce is likely to be treated as a relief rally rather than the start of a sustained uptrend. If we look at the commodities on a weekly basis, well, it was all mixed. Crude oil was the standout performer, rallying really 6% for the week, and you know why, while copper posted a modest gain of 0.5%. Precious metals, however, came under pressure. Gold fell 2.2%, while silver dropped a sharp 6.4%. Natural gas was the weakest performer this week, declining over 8%, although it still remains the best performing commodity of 2026, up around 140 points on a YTD basis. That's pretty much it on the commodities this week. Before we wrap up, here's the study I was talking about in the beginning. Well, since the past several weeks, I've been saying that the mid and the small caps are doing way better than large caps, and this is something which has been going on for a while now. I thought, why not show you a visual for the past decade in terms of how this performance divergence has played out in the past 10 years. Now here's the chart for you. Now let me quickly explain what you're actually looking at. Now, on any given day, we look at exactly 1 year back and check how much did the small cap 250 return over those 12 months and how much did Nifty 100 return over the same 12 months. The difference between the two is what is plotted here. So for example, if small caps did 30% and large caps did 10%, the line plots it at plus 20. And the gap is measured in percentage points, which is simply the arithmetic difference between the two percentages. We repeat this calculation every single trading day, which is why it's called a rolling 1 year spread, because the 1 year window keeps rolling forward with time. Whenever the line is above zero and shaded in green, small caps have beaten large caps over the trailing year. And the red zones below zero means large caps were leading in that period. The solid green line tracks small caps versus Nifty 100, and the dotted orange one does the same for mid-cap 150. One glance and you can see how the leadership keeps swinging between the two ends of the market. Now let me walk you through what stands out in this decade-long data. The early years, that is 2016 through early 2018, were firmly with small caps and the spread stayed green throughout this period. Then came the longest red patch on the chart, a brutal 28-month stretch from April 2018 to August 2020, where the large caps stayed ahead without a break, and at the worst point in Jan 2019, small caps were trailing the Nifty 100 by over 31 percentage points on a 1 year basis. The post-COVID recovery flipped that completely, with small caps running ahead for a year and a half and peaking at nearly 71 percentage points of outperformance in July 2021, the widest gap of the decade. Another long green run followed from mid-2023 to early 2025. And interestingly, the second longest red zone of the entire decade is very recent, running from July 2025 to Feb this year, roughly 7 months of large cap leadership before the market flipped back again to green, which is exactly the shift I've been talking about over the past several weeks. Now, if we zoom out of this, the takeaway seems to be pretty clear. Small caps have spent roughly 60% of all trading days ahead of large caps, and mid caps are remarkable 75%. So while the leadership swings both ways, the broader market has spent more time winning. Now, if you look at this data, maybe there is merit in chasing the mid and smalls over the long run. Well, what do you all think? Let me know in the comments. So yes, in summary, Nifty ended the week almost flat, but it was anything but quiet. Wednesday's sharp sell-off briefly broke the short-term structure, only for Thursday and Friday to reclaim the 2150 and 100-day EMAs. The 23,800 zone once again held firm, while 200-day SMA around 24,850 remains the next major hurdle. The broader market continues to outperform, with mid caps and small caps extending their lead over Nifty. Nifty Mid Select also became the first major index to reclaim its all-time high. Sector leadership remained with realty, while microfinance, pharma and auto ancillary continued to stand out. In commodities, crude oil rallied, but gold and silver remained under pressure. Well, the bottom line, the broader trend remains fairly constructive, skewing towards bullishness rather than bearishness. And the Wednesday's crash didn't seem to have caused much damage actually. And as long as Nifty holds above the 24,200 and 23,800 support zone, the focus remains on the potential move towards the 200 SMA, and eventually the 25,000 number. Moving on to what caught my attention this week, well, I've got two picks, both tied with the news we started with. The first is a long read from the Indian Express on India's seafarers. Now, did you know nearly 1 in 5 sailors worldwide is Indian? And this piece takes you inside the academies that train them, the small towns they come from, and what it feels like to take an oil tanker through the Strait of Hormuz with missiles overhead. Given the week we've had, timely and a very human read. The second is the Systematic Investor podcast from the Top Traders Unplugged, featuring Kem Carson, one of my favorite market analysts. He argues that America is quietly drifting away from the traditional free market capitalism towards a more strategic model where government, markets, and technology are deeply intertwined. He also adds that the US midterms, which are around the corner, could be the next big catalyst. Provocative in many ways, and at under an hour, it's an easy and interesting listen. As always, the links are in the show notes. Now, over to the events to factor in for the coming week. Well, looking ahead, it's a fairly quiet week on the macro front. India's CPI inflation comes on Monday and WPI inflation on Tuesday. Those are the key scheduled events, but unless there's a significant surprise, they are unlikely to move the markets in a major way. Other than that, it's a relatively light calendar with no major known macro events lined up for the week. So yeah, that's pretty much it for the week. If you find this series useful, don't forget to subscribe to the channel, and yes, do share it with your friends. Until then, stay curious, stay steady, and enjoy your weekend.